For Morningstar, I'm Jeremy Glazer. I'm here today with Josh Peters. He's the Director of Equity Income Strategy here at Morningstar and also the editor of Morningstar Dividend Investor. We're going to talk about what impact rising rates will have on dividend-paying stocks. Josh, thanks for joining me today.
Good to be here, Jeremy.
You've looked back at some previous rising rate cycles and what impact that's had on higher yielding sectors. What did you find in that research?
My look back at rate cycles over the last 20 years did come up with some pretty predictable results, which is that you see a pattern that higher yielding stocks and higher yielding sectors within the market tend to underperform a broad market benchmark like the S&P 500 when interest rates are rising. And I used for that reference a 10-year Treasury yield that goes up more than 1 percentage point from the bottom. On average, during these cycles, the S&P 500 has a total return of 11%, which is pretty good. It kind of makes you wonder, why investors in general should be so worried about rising interest rates. The Dow Jones U.S. Select Dividend Index, on the other hand, which is a pretty good benchmark, goes back to the end of 1992, covering this high yield sector of the market, has had an average total return in these periods of only 3.7%. So on average, still positive, but not much capital appreciation and that relative underperformance. However, within the numbers, depending on how you want to treat different rate cycles, I actually think that it's not even that bad. If we exclude a couple of really unusual periods, the immediate post-crash period in 2009, as well as the dot-com bubble era where anything and everything that was associated with old economy, including dividends, was tossed out in the trash, then you have a pretty comparable level of performance. On higher yielding stocks, that Dow Jones Select Dividend Index only underperformed by a little less than 100 basis points during those rate cycles. So, I think having come this far in this rate cycle, interest rates, long-term interest rates are already up a full percentage point or more from the bottom. We've seen the same pattern hold true. High yield stocks have underperformed, but you're still making money. You're still collecting the dividends, and even if you're not getting as much capital appreciation as the rest of the market, you're still getting some.
Utilities have been hit particularly hard recently. Has that been the case through other cycles?
Yeah, and that actually gets to the underlying reason why higher yielding stocks tend to underperform in an interest rate cycle. It's not just that interest rates are going up and that the natural buyers of utility stocks or staple stocks, telecom stocks, would also be potential buyers of bonds and are just shifting their money out because interest rates are going up. It's also because that these are typically defensive, economically defensive, high quality businesses. Their earnings tend not to go down that much in recessions, in periods of economic or financial stress. So as the economy recovers, which is typically associated with a rise in long-term interest rates, they don't have as much to gain back because they didn't lose it in the first place. Utilities definitely fit that profile. You don't have a lot of earnings downside in recessions. You do have a little bit of a bounce back when the economy recovers and, say, industrial power demand goes up. But at the margin, it's not a real big impact. So you see investors, just as the market passes through cycles, decide to go off and chase, perhaps faster growing or more cyclical or more speculative investments. But that's not necessarily how you want to frame a portfolio. I think you want to think over many cycles. What kind of companies do I want to own? What kind of companies can I afford? No, I can keep even when share prices are falling. I think for most investors, they're still better off with those defensive stocks through the boom times and the bust times, whether or not, as opposed to going out and trying to time cyclical sentiment shifts in the market.
So has this underperformance created any opportunities to pick up some of those defensive stocks then?
Well, that's the interesting point here, is that even though they have underperformed relative to the rest of the market over the last couple of months, which has made them somewhat more appealing on a relative basis, share prices have still gone up in general, and there aren't a whole lot of what you'd call flat-out bargains. But there are plenty of what I would call good deals. A company like American Electric Power in the utility area, predominantly a regulated utility. It's had a little bit of an earnings decline because of the recession. They're concentrated a lot of their businesses in Ohio and Indiana, states where manufacturing is heavy. They have the opportunity to bounce back a little bit in a better economy. But you've also got management raising the company's payout ratio target to a 60 to 70% range, which is still very safe given their earnings profile, but it's going to allow them to raise the dividend faster over the next couple of years than they would have otherwise, and you're getting a yield over 4%. Also, a name like Clorox. People are not going to use a whole lot more bleach just because the economy happens to be growing faster. But it's a great collection of brands that throws off great cash flow. You have a very strong management team here that does a wonderful job allocating capital and really prioritizes dividends as a way to reward shareholders for their capital being in Clorox. A name like that, and in the low 3% area. I mean, these are the kind of names I'm willing to ride through whatever happens next. And the fact is we just don't know. Long-term interest rates have gone up, but there's not much sign that the economy is growing faster. There's even less sign that there are inflationary pressures out there. If interest rates continue to rise from here, we might not be worrying so much about interest rates going up as the fact that we could have a recession triggered by a mistake in monetary policy. So you have to put all of the potential outcomes on the table, not just think in terms of interest rates going up indefinitely, and look to suit your portfolio to what you're trying to accomplish over the long run with your money.
Josh, thanks for sharing your thoughts with us today.
And thank you too, Jeremy.
For Morningstar, I'm Jeremy Glazer.